Hello, everyone. Welcome back to the Daily Gold YouTube channel. Thank you so much for tuning in. This video is being recorded on the early morning of Tuesday, August 26, 2025. It's a Tuesday edition of Macro Mondays, and this is an important one. In this video, I want to answer some questions and some comments that I've been getting, various comments on the channel and lots of emails from subscribers and other followers, and people are concerned. Oh, I'm worried about a crash because the market's going to crash. Are we going to see another 2008? I'm worried the stock market's going to crash and we're going to see miners crash and gold down 30% and silver down 70% again. And I'd just like to answer all these comments and really ease your fears. People, we are not going to see anything like this anytime soon. There's many reasons for this, and I'm going to go into what I think are the most important in this video. So without further ado, let me get to the video. Let me discuss these reasons. Okay, so we're looking at the major asset classes here: stocks, bonds, gold, and gold stocks. This is the Barron's Gold Mining Index. This is the total real return of bonds. So it's the inflation-adjusted return in bonds. And so this is probably the most important reason why we're not about to see another 2008 with respect to precious metals. We are in a secular bear market now in the bond market. And this is my demarcation line, this moving average. I'm using the 80-month moving average to define the secular trend in bonds. Now for stocks, it's the 40-month moving average. And you can see how well both these moving averages work. We're still in a secular bull now for stocks in the S&P 500 and US stocks. But for bonds, looking at this 80-month moving average, we lost it here after COVID. The COVID peak, that marked really the end. That was the top, the end of the secular bull in bonds. And people, we have not seen a secular bear in bonds for many, many years. We haven't seen this since the end of the 70s or the early 80s. That's 40 plus years. That's 4 decades. Not to mention, if you go back to 1900 into 1920 or 1921, to 2020 or 2021, this 100-year period, 100 years, the only time there was a secular bear in bonds was this period here, the mid-60s to the very early 80s, where you lost money in bonds. That's where we are, here and now. And another thing, and I've said this in another video, with the exception of this bear market right here, 74 to 75, other than this, every crash in the stock market's history since 1929, they occurred when there was a secular bull in bonds. Well, why is that? Well, if bonds are going up and you can make money in bonds and you're worried about the stock market, you can just sell and put your money in bonds and earn 2, 3, 4, 5% a year. No risk because you're in a secular bull in bonds. So again, 1929, 1937, 1987, 2008, 2020, the COVID crash, you were in a secular bull in bonds. That's why the market crashes, because people can sell and put their money in bonds. This period right here, when you were in a secular bear in bonds, there were basically no crashes. And these two bears, by the way, they were really different because in those other bear markets, when you had crashes, typically there's 3 legs. Or what I should say is typically the worst part of a bear market is in the middle. There's 3 legs. You get the first leg down where people don't think it's a bear market yet. Then you get the accelerated decline in the middle where it's like, holy shit, we know we're in a bear. And by the time that's over, the bear market's almost done. Now, in this inflationary era with the secular bear in bonds, these were different. That holy shit, we're crashing or we're facing an accelerated decline, that didn't happen until the very end of these bear markets. You can go look at them on a better chart than this. So these bear markets, 2/3 of the way in, they were down 18%, 20%, 18 months into it. They were mild bear markets until the very end when you had an accelerated decline. So I know I'm rambling on, but this is such an important thing to understand. And look, if we get a recession and a downturn, sure, the bond market will probably rally. It's been really oversold for a long time. But bigger picture, this is not in 2008 territory. Not even close. Just a couple other things I'd like to add. We know that gold stocks here broke out in 1964, and you couldn't buy gold during that period. So this massive breakout, which goes back to 1938, by the way, that was basically similar to this gold breakout right here. And if you look at this huge move from 64, beginning of 1964, in fact, you did not get a real bad bear market for another 4+ years, another 4.5 years or so. So let's just say this ran up for another, or for 4.5 years from the breakout in 2024. That's looking, that would take us to the end of 2028, maybe even early 2029. So we're still 3+ years away from that. And I do think at some point, maybe 2029 or 2030, you get that nasty bear market in the middle of the secular bull, because we all know that happened here. And it happened in 2008, of course. But that did not happen until gold moved from 35 to almost 200. And silver made a huge move as well. And the stocks went crazy during that time. So yes, we're doing really well. I like how things are performing, but based on that, I don't see crash or serious bear market risk in this sector for another 3 or 4 years at the soonest. Okay. There's not more important, but there's other important reasons I want to get to. Now, this is important to understand. Gold against the 60/40. Confirmation signal here. Now, for gold stocks, it occurred in the mid-60s, but because gold was artificially fixed or artificially cheap, it didn't occur until here. Then it occurred here. Now it occurred here. Now, what happened here? The stock market went down. That was at 50% bear market, 48%. What happened to gold? Gold went up like that. Gold stocks, they shot higher. Similar thing happened here. Gold stocks actually bottomed even before. So they went like that during the bear market, during this 50% decline. Gold trended higher as well, silver a little bit as well. So this period and this period right here, you had an inverse correlation. Okay, well, why is that? Well, you had the end of secular bulls in stocks here and here. Now, gold was fixed, or we would have seen the move right here. So it happened at the next point. But this is important to understand. At the beginning of a new secular bull market in gold, as confirmed by these points, there has to be an inverse correlation between gold and the stock market, because money is coming out of stocks and going into gold. That's what happened here. That's what happened here. That's what's about to happen here. It could happen in the next year or two. Okay, this is important to understand, because gold doesn't begin a new secular bull market with the stock market still going up and gold just starts going up and it goes up at a much higher rate. It doesn't work like that. You need a bear market in the stock market, and then you get that capital going to gold, and that's how you get the inverse correlation. So I think we're setting up for something like that can happen in the next few years. And so let me delve more into the 70s and the 2000s here in that inverse correlation. Okay, so 1973 to 78 is when we had the inverse correlation. And so we can see here, here's gold, silver, here's gold stocks, here's gold against the 60/40, here's the stock market. So here's 1973. This is the bear market in the S&P 500. Now, I think the recession ended like right here, probably started somewhere around here. So this is the bear market in stocks. Here's gold against the 60/40. Remember, you had that breakout here in 72. Then you had this explosion like that. So what happened? Gold, look at that. Huge move. Silver, huge move higher. Gold stocks, another huge move higher. So capital was finally moving out of the stock market and into precious metals. And the same thing happened. This is silver. I mean, if I go back here, the same thing happened 2000 to 2003, it was a little different. Wasn't an inflationary time because you had a secular bull in bonds at the same time. But here, the end of the secular bull in the stock market, what happened? We can see gold against the 60-40 bottom, then it moved higher like that. But here's the bear market in the stock market, March of 2000 all the way to the end of 2002. And look at gold stocks. They were the first to bottom, actually. And so they moved like that. Really strong move during the bear market. Silver wasn't quite as strong. Yes, it didn't perform really until the end of the bear market and the stock market. And then here's gold, steady rise. But the gold stocks really during that, they performed fabulously. But again, this is a little different than what we had here because during this period, you had, at this point, you had a secular bear in both stocks and bonds. Now here, you only had a secular bear in the stock market, but still, you had to have an inverse correlation. I hope I'm explaining this well. You had to have an inverse correlation. You had to have money moving out of stocks and moving into precious metals. And so precious metals were rising when the stock market was falling. That's the only way it happens. Now, I want to get to this because I've also got some questions about silver. And I know it's a common thought out there that you can't buy silver or don't buy silver until the stock market bottoms. Silver's big moves happen after the stock market bottoms. Now, yes, that happened in the 2000s. If you only go back to the 2000s and that secular bull, yes, that's what happened. I just pointed it out on this chart here. Silver, you can see here, it didn't really start moving, bottomed here, but didn't start moving until the stock market recovered. And of course, the same thing happened late 2008, or that happened before the market bottomed. But that was a period, the 2000s, you didn't have a secular bear in the bond market. You weren't losing money on bonds. This is the period when people were losing money in bonds. Okay, so here's silver here, going back to the mid-60s, and here's the stock market here. So I put all the lines here when the stock market made bottoms. So we have 1, 2, 3, 4. Of course, these were the two worst bear markets. Now, this was the end, or this was the bottom of the 68 to 70 bear. But look what happened to silver. Silver kept going down when the market recovered. So the low in silver didn't coincide with the low in the stock market. The same thing happened here. You have the stock market bottoming here. You have a crash bottom here. Then it gains traction early 75. But silver still consolidated for several more years. And then you have this one here where silver actually bottomed and started moving. What is this? Like about 6 months before this bottom in the stock market. And then you go back to the beginning. Now this was one point where it could have actually made sense. The bottom in 66, if you're able to buy silver, then it would have paid off until this peak right here in mid-68. So we have to be careful about making these declarative statements. In recent years, sometimes I made statements like that. Well, the market has to go down for precious metals to go up. It is true to some degree, but we haven't seen that now. But this just goes to show you this is completely different than what happened in the 2000s. And again, this is a better comp for where we are than the 2000s because of the secular bear in bonds. Okay, I already discussed this chart. And here's another thing about 2008. Did you ever consider that was 7 years into a secular bull in precious metals? Remember, you just saw gold broke out against the 60-40 at the very beginning of 2002. So 2008, that was 6 years into the breakout of gold against the 60-40. We're less than a year into that breakout now. And so we can see this is the implied allocation to gold based on the ETFs. This is from Top Down Charts. Callum Thomas, by the way, great follow on Twitter. I'm a subscriber, love his charts. So we're looking at what's the market share of all gold ETFs, the assets, divided by all ETF assets. So this is early 2008, right before the market crash. So look how high this was. Before that crash, this was nearly at 8%. Look at where we are now. We're not even at 2%. Okay? All the money is still in stocks. In 2008, Again, this was 6 years of gold outperforming the 60-40. You can see here, gold against the 60-40. Look at that. This is where we are now. We've only had this. So this is not even close to 2008. And in 2008, precious metals made significant gains from 01 to 08. Really huge gains. We're not even close to that point yet. Okay, and last thing, let's talk about the debt, okay? 2008, this is U.S. household leverage. This looks at the ratio of liabilities to net worth, okay? So liabilities for households to net worth. This is 2008, okay, off the chart. This is where we are now. So this is like at a 55-year low. Here's household debt as a percentage of disposable income. This is probably better because this is based on asset prices. So household debt as a percentage of disposable income. This is 2008, okay, 115%. Where are we now? 85%. Still kind of high, but we're still way below. We're way below where we were then. And here's this chart where, okay, here's debt to income ratio for consumers, corporations, and then the government. So here's consumers. They've delevered a little bit since 2007. Here's corporations. They've delevered a lot since 2007, okay? Here's the government. They've levered up, okay, while everybody else is delevered, okay? And it goes back to my first point about the bond market. 2008, that was a private sector problem with respect to the debt. You were in a secular bull market in bonds. Now the problem is the government. And that's why we're in a secular bear in bonds. Okay, so this is completely different from 2008. I do want to go back to something I mentioned about 1968. So the gold stocks broke out in 1964, and they had that first cyclical peak and a nasty bear after that. So that was 4 or 4.5 years after the breakout. That would take us to late 2028 or early 2029. So I talked about it in my book. We're in a great bull market for precious metals, but there will be that nasty bear market coming at some point, probably 2029-ish. That's my guess. So I'm not saying that precious metals won't crash at some point and have that nasty bear market. It's just that it's not happening anytime soon, and this is nothing like 2008, okay? Get it straight, people. Rant over. Thank you so much for tuning in. Let me know what you think. I really appreciate your support and all your comments. And I hope you have a great rest of the week. And I'll talk to you guys again in the next video, probably in our Friday weekly market recap.